First of all, the most important principle to me is that the great bubbles are quite different from ordinary bull markets. And if you average in the others, you get a lot of dilution and you miss the point. The great bubbles, most of them 2.5 sigma or 3 sigma events, are 1929, 1972 is kind of an honorary member on the cusp. 2000, the great tech bubble, a beautiful one. The most symmetrical of all is the housing bubble of '06, 3 years up, 3 years down, perfect. And this one, let's call it 2021. And of course, the mother and father of all bubbles, Japan, 1989, in both the real estate land market and the stock market. Now, when you look at the consequences of those great bubbles, life is pretty simple. They all get there after a long period of economic growth, economic conditions that are perceived at the time as nearly perfect, profit margins nearly perfect, investor confidence more than perfect, absolutely in full screaming blossom, where people are buying stocks because they're going up and forgetting about fundamentals, where leverage has gone up a lot, and where people have started to cheat and weasel more than normal because they can. Ponzi schemes have taken root here and there. Galbraith said that the size of the bezel had grown. And it always turns out that way. And from those points, from those dizzying points in 1929 and March of 2000 and late 2020, early 2021, you could argue there's only one way things can be resolved. Eventually, the easiest thing is to prick the bubble of perfection, convince people that things are not going to be perfect forever, which they believe at the top. And that way, you nearly always get a fairly rapid unraveling of the most speculative stock. Uniquely, you get this divergence where the beginning of the bubble, the speculative leaders go down, sometimes a lot, while the big blue chips continue up. And people think, what are you talking about? This isn't a bear market. The S&P is up 20%. The S&P, it was up a lot more than 20% in 1929, but the low-priced index, the speculative guys, were down 35 to 40% the day before the crash in 1929. And you had nothing like that divergence. The low-priced index had been up 85 in 1928. Nothing like that divergence where the high beta stocks are going down. Forget underperforming until you get to 1972. 1972, the S&P is up a bit, 17%. The average big board stock is down 17%. That symmetry means I can remember it forever. And you get nothing like it again until 2000, where, as most of you can remember, what happens from March of 2000 is the pet.coms go practically broke in a few months, and the growth stocks start to peel off from the junior growth stocks month by month, working their way up to the Ciscos. By the end of the year, after a decent rally at the end, the NASDAQ is down 40%. The balance of the non-growth market is not down at all. The S&P is down, but it's entirely the growth stock. The balance of the market is probably up in the low double digits. And then again, no such divergence until, drumroll, 2021. In 2021, I'm told there was a bull market. You couldn't tell any growth manager that there was a bull market in 2021. Kathy Woods' portfolio was in whole-scale retreat for the second half of the year, down big for the year. And my own favorite, QuantumScape, my favorite only because I bought it 7 years earlier as a startup. And it came at 10 in late 2020, like any SPAC. I hate SPACs, but it was, despite me, came as a SPAC, went from 10 to 130, $52 billion for a research effort that wasn't going to have a product by its own admission for about 4 years or so, and selling for more than General Motors or Samsung, the battery company. I mean, that was, in a way, the apex of the meme stocks. I was too close to it to see it as a meme stock. And it peaked in December 2020, the first one, because it was the most crazy. And then the meme stocks joined in March, April, started to go down in 2021. The number of new issues peaked in December, January 2021, December 2020, and it rolled through the year. But the S&P was up 20. The growth stocks were hammered. A classic and unique signal. And then we've gone through the paces, on average, looking perfectly normal for the great bubbles. So the first thing that happens is you prick the bubble of that supreme overconfidence. It leads the way down, and it continued down handsomely for the first half of 2021, by which time most of the growth leaders were down 40 to 80%. And my own QuantumScape bottomed late last year at 5.1, down from 130. That's what you expect. And incidentally, to get ahead of myself, then of course they rallied in the January bounce back of after tax loss selling. When you've gone down to 5.1, you've got a lot of tax loss selling to do. Then you have the money, you have your Christmas bonuses, and you look around for your bargains. And in those years, every 10 or 15 years, you should expect a terrific January bounce. QuantumScape went up 120%. The Cathie Woods probably went up 40. Some of the meme stocks went up 50 to 100. It's what happens. It's what happened, by the way, in 2001. Following the great tech rout of 2000, it was a heck of a January rally, including on the second trading day, it went up 14%. The Nasdaq still it's the biggest one-day rally. It finished up 12% for January, which it almost finished up this year too. And then in 2001, despite being up 12% for January, it was down 20% for the year. So in a nutshell, I was fearful of a rally as a bear. I was fearful of a rally in the specs, which we got. And that was part of the reason I said, after a timeout, back to the meat grinder. Reason number one was the January rally, which is classic, typical, should have been expected. And reason number two was the presidential cycle. Neither of these things are talked about by fee charging enterprises. They're too simple-minded, and it doesn't feel like you should charge a fee for it, and therefore no one will talk about it. And that's probably why it worked. The first account we had at GMO 45 years ago used both the January effect and the presidential cycle. It had worked for 45 years then, and it's worked for the 45 years since then. And the main reason is probably that it's so simple-minded, no one will touch it, including GMO, basically. However, I'm retired from managing portfolios for 15 years, so I'm allowed to wander into these zones that other people won't talk about. The presidential cycle is just amazing. It's one of those few things that you can understand completely. You know exactly what's going on. What's going on is you want to stimulate the economy to have a beneficial effect running up to the election. And so we studied what moves the vote. And there's only one thing we could find, and it's probably because we were dopey, but we tried very hard. The only thing we could find was the state of the labor market in the 6-month run up to the election. Anything that happened before that was deemed irrelevant. You could have a brilliant labor market for 2 years, and then if it was bad in the 6-month run up to the election, it would cost you vote. So how do you get to have the labor market be a little stronger or a lot stronger than average? And that is you have some moral hazard. You get the government and the Fed to say encouraging things, and you stimulate the economy typically, but you have to do it in advance because the economy is a slow-moving beast and takes a year and a half, year and a quarter to have an effect. So it turns out that zone is October the 1st of the second year, which this time round was last year, until the end of April this year. In that sweet spot, in that 7-month window, since 1932, since FDR, that 7 month has equaled the remaining 41 months of the presidential cycle. I am not kidding you, check it. Which means per month, that 7-month window is 7 times average. I remember looking at David Rocker, who was a great short seller who blew up in Lehman through no fault of his own. He was custodied in Lehman, UK, and basically went out of business. But he had a wonderful record. And I once looked at the 7-month window, and in his 22 years of brilliant performance, he had only made money once in that 7-month window, going short. It's like the short seller's graveyard. And so I treat it with respect, and hence timeout. So I didn't know there was going to be, of course, a minor financial panic, and that may change the game. Every cycle is a bit different. But I was counting on the fact that it is generally tough, starting last October the 1st, to get the market to go down through the end of April, which is in 6 weeks' time. And then, of course, all bets are off. And I believe, back to the meat grinder, there is enormous inertia in these events. And what we've had is we pricked the extreme optimism for 6 months, first half of last year. Then we had a magnificent rally like we had in 1929, and we had some good rallies in 2000. And that's par for the course. So we had a good rally. And then the difficult phase is always phase 3, which is the fundamentals, waiting for basically earning and fundamentals like unemployment and the GDP growth to turn down. And they do it with leads and lags, which would make your hair fall out. It's always different etc. But without getting into too many details, which everyone does, we all get into too many details. The big picture is we have a little handful of these super bubbles. Every one of them is followed by a recession, right? That's pretty simple. If you get anything really wrong, like 1929, it's followed by depression. If you mess around with the financial system, you have the terrible happenings of the great financial crash. But if you do everything more or less right, if the housing market is just fine, actually cheap in 2000, the bond market is very cheap in 2000, you're really trying to make life simple, you still have a mild recession. And you still have the NASDAQ go down 82%. You still have the S&P go down 50, even though Greenspan is roaring in to help it, to cushion the pain, to make life friendly, lots of moral hazard, lowering the rates, and still it goes down 50. So the big picture is you always get a recession, you always get a terrible wipeout of the spec, and you get a pretty hefty decline in the S&P. And if you do anything gratuitously worse than that, like having a bubble in more than one asset class or messing up your economic policies or your financial policies, you will do worse and things will be bad, which we'll get to. Japan, of course, committed the heinous crime of having the greatest bubble in real estate simultaneously to the greatest bubble ever. 65 times earnings in the stock market. But the 65 times earnings was not nearly as bad as the bubble they had in real estate, where the land under the Emperor's Palace actually really was worth more than the state of California, and more than 10 times the square foot rent downtown Tokyo to New York, to Manhattan. Just incredible. The biggest bubble, I suspect, in history, including the South Sea bubble and tulips.